Hello everybody, welcome to another update on the stock screener. Today we're going to talk about Cerrado Gold, which is a new holding of mine. The reason that I bought Cerrado Gold is that I wanted to get rid of some copper miners because there are some reasons to actually be bearish on copper. Now gold has been doing well, it's actually going up. But yesterday we had some interesting news from the FOMC meeting, and they were going to keep on raising the rates up until 3.5%. So this is actually very bearish for the economy because GDP is going to drop, unemployment rate is going to go up, and inflation is still going to be very high. So I think this will trigger a stagflationary cycle, and you do not want to be in stocks, and that means also not in copper. Also, the GDP is really going to go negative right now, so they are actually hiking rates while GDP is negative. So we are going to go into a recession. Also, Yardeni decreased his outlook. So this was the old outlook with still some hope for stocks going up. And then we got this. So both bands were lowered and we could see an even lower bottom here. So if stocks go down to here, you can bet that copper is not going to do well. So I see no upside anymore for stocks and also copper, because copper is called Dr. Copper. So that's why I lightened up on some copper stocks and bought a new gold mine, which is probably going to do well because gold is going to rise to 2000 by the end of the year. Now, Cerrado Gold, this is a gold mine in Argentina, and it also has a project in Brazil. So let's take a look at the valuations. Market cap is at 100 million, PE ratio of 7 right now, so it's fair value. EBITDA at 30 million, so 3 times EBITDA, that's not bad. Price to book is a bit elevated and also a lot of debt. But I think that they will be able to pay off that debt in a few years. Now, what's very interesting about this company is this production profile. We always want to buy a company with rising production and decreasing costs, and that's exactly what we have here. Currently, they are around 50,000 production, and that's going to increase by 50% next year to 70,000. And then they are going to double it to 100,000 the following year. So a lot of growth coming, and their costs are declining by 10%. So this is all organic. So it's an easy double or triple from here on out if you can wait 2 years. But then in 2025, the real thing happens. They will go from 100,000 production and double it to 200,000. So this is the real play here, and the cost will further go down until 900 AISC. So we just use our valuation metric again, production times price minus costs times 5 multiple, and we get this scenario. We are at 100 right now. It's already undervalued by 30%. By next year, it will, so this is next year, it could double from here, from 100 to 200. And then in 2024, it will triple to this point. And that's all because of the production increase from 50 to 90,000 and costs being reduced. And this is at gold price of 1830. Then we have that nice project in Brazil that will add a huge chunk of value if they can get it in production in 2025. And that would give us an 8-fold. Okay. And that projection is even going higher in 2026. So it will give us more than 8-fold, so maybe a 10-fold. Okay, so that's the outlook for this company. Current NPV, let's take a look at the NPV. It's 800 million right now on this project alone. And the capex is 126 million. So let's use our normalized NPV technique. 800 million for a mine life of 8 divided by 2 to get to 4 mine life would give us an immediate value of 400 million. So this project on itself is worth 400 million. We are currently only at 100 million. So that's huge upside for this project alone. 400 million, and what's the capex? Only 100 million. So we have a normalized NPV to capex ratio of 3 to 4, which is a very good project. Low capex giving huge value. So yeah, I'm a fan of this company. I think this can easily double, triple in the coming years. And gold is going higher. So let's say gold goes to 2000 by the end of the year. Then we get this scenario. From 100, we go to 200 this year. Next year could go up 2.5, and then we go to 3.5 upside in 2024. That's plenty of upside, and not even counting in this huge upside for the Brazil project. The balance sheet, we know equity is still low, but they will have good earnings at a PE of 7, which is going to come down to PE of 5. So no worries there. They will be able to pay off the debt, which is, current liabilities is 60 million and non-current 50 million. So they will be able to manage this. They have enough current assets. Revenue-wise, we see that they are making money. 30 million the last quarter. A bit of costs here and 30% margins. Then some administrative expenses, and we get around 10% margin. 10% net margin, not that great, but we know that this is going to increase in production, so those margins will increase in the coming years. So that's what I bought. And you can do your own due diligence on this company, and I'll see you in the next video.